Hello, my name is Diego Sabut, NPM, 24,412,011, Faculty of Business Economics, Accounting Study Program. Accounting is one of the important aspects in the world of business economics. The study of accounting helps us understand the process of recording, classifying, and presenting financial information. This is useful in helping economic actors to provide certainty of financial information to prospective investors, company managers, tax authorities, and other parties that have an impact on the allocation of company resources. In the midst of the complexity of financial transactions, the basic accounting equation appears as a solid foundation for organizing and recording all transactions. For that, let's get to know more about the basic accounting equation in the following explanation. Understanding the basic accounting equation. The basic accounting equation, also known as the financial equation, is the basis of the accounting system. Quoted from the book Introduction to Basic Accounting by Siti Aisyah Siragar, the basic accounting equation is an equation that generally describes the financial relationships that occur in a company. This relationship includes wealth, assets, owned from economic sources obtained from debt obligations, liabilities, and capital, equity. The principle of the basic accounting equation states that a company's assets must be proportional to the amount of debt obligations and capital of the company. This equation is used to explain logically that every transaction that occurs will always affect the assets, liabilities, and equity in the company. The main function of the basic accounting equation is to maintain the financial balance of a company so that changes in the elements or financial position of the company can be known. Thus, the basic accounting equation shows the balance between the amount of company assets with the amount of liabilities and business capital. Basic accounting equation formula. The basic accounting equation is an equation to show the balance between assets with the amount of liabilities and capital or equity. Quoting from the Basic Accounting Equation module by Leah Malyani, the concept of the basic accounting equation can be seen in the following mathematical model. Assets equals liabilities plus capital. Liabilities equals assets. Capital equals assets. Liabilities. According to Eka Satria Wibawa and Srawahuning in the book Learning Basic Accounting, the interaction relationship between assets, debts, and capital in the basic accounting equation is temporary. The changes are expressed in plus, or minus, on the right or left side of the equation so that both sides reach balance. Basic accounting equation elements. To further understand the basic accounting equation, here are its components. 1. Assets. Assets are assets owned by a company. All economic resources owned by a company are counted as assets. Based on their form, assets are classified into three types, namely current assets, cash, fixed assets, land, buildings, production equipment, and intangible assets, copyrights and patents. 2. Liabilities. Obligations or debts, also known as liabilities, are a financial burden that must be met by the company. Liabilities arise as a result of actions or transactions carried out in the past and their settlement uses company resources. Types of debt include short-term debt, trade payables, bank debts, salary debts, and tax debts, and long-term debts, securities, bonds. 3. Capital. Capital or equity is the net wealth that is the right of the company owner. Equity is part of the company's assets owned by shareholders or third parties. Examples of equity accounts in general are share capital, share premium, retained earnings, owner's capital, and privé or capital withdrawals. Example of basic accounting equation quoted from the E module of the Directorate of High School Development, basic accounting equation compiled by Yoshi Chandra. Here is an example of a basic accounting equation. Mrs. Linda deposits cash as initial capital for her business, namely, Linda Taylor, of Rs. 8 million. Then, for additional capital, Mrs. Linda borrows money from the bank for Rs. 10 million. Then, Mrs. Linda buys a new sewing machine for Rs. 14,800,000. So the basic accounting equation is as follows: assets equals liabilities plus capital. Rs. 8 million equals liabilities plus Rs. 8 million. The effect of the first transaction is an increase in the company's assets in the form of cash by Rs. 8 million and also on the capital side by the same amount. Assets equals liabilities plus capital. Rs. 18 million equals Rs. 10 million plus Rs. 8 million. In the second transaction, there is an additional asset of Rs. 10 million from bank debt or business liabilities. Assets equals liabilities plus capital. Cash plus sewing machine equals bank debt plus Linda's capital. Rs. 3,200,000 plus Rs. 14,800,000 equals Rs. 10 million plus Rs. 8 million. The third transaction causes assets on one side to increase in the form of a sewing machine of Rs. 14,800,000.00 and assets on the other side, namely cash, to decrease by Rs. 14,800,000.00. Changes in the composition of assets do not change the amount of liabilities. Thanks for watching.